Brexit vote caused a shockwave through the world's stock markets, which may have put you a little on edge about your own financial future. So what can you do to be a little more wealth smart? On our Money Monday, Reid Johnson with Lake Point Advisory Group is here with some more information. Thanks for being here.
Thank you for having me.
Okay, so there are many mutual fund options, obviously, and people are concerned about their retirement. So how do we know which way to go about our 401k?
You know, that's a great question. That's the first question that a lot of folks ask us when they come into our office is, hey, you know, I have a brokerage account, I have a 401k account, and there's all these different mutual fund options that I can choose from. Which option do I choose? And that's a hard one to answer because you can have two different funds. They have the exact same performance when you're going through your chart, and if you don't know any better, you could literally choose the wrong option even though they have the same performance. So what that means is if you have the same performance, one could end up having thousands or literally thousands of dollars per year more in your portfolio.
Okay, so if two investment options had the same average return, how would my money grow? Which option would be better?
Well, you know, this is where investors and advisors sometimes get it wrong because the first thing they're going to try to do is go with the fund that actually has the highest performance. But we were just talking about two funds that actually have the same performance. So in order to show you which one of these would be better, you have to do a full analysis. And so I'm going to give you an example of a couple of portfolios. We actually had some clients, Jerry and Betty, who came into our office, and this was their concern. They were like, Reid, I have these two different funds. They have the same performance. Which ones should I choose? And so we broke these portfolios down, and let me kind of show you what ended up happening.
Sure.
Portfolio A, for the last 5-year performance, you'll notice that the return here on Portfolio A had a 16% return year one, a negative 37% performance in year two, and some great performances 3, 4, and 5, and the average performance, or what the prospectus would have told them, was 5.53%. Whereas Portfolio B, same exact type of situation, but there's a little bit less return. Instead of 16 in the first year, it was 7. Instead of the large 37% loss in year two, it was negative 9, and then 14, 11, and 4. But what's interesting is both of these had the exact same performance. So which one of these do you think would have produced the most results, or the same?
I'm thinking B, and I'm thinking obviously people will want Portfolio B.
Portfolio B. Well, not necessarily, because if you're looking at two average performance, it might actually end up being the same result. That's what most people think. But you're right. You've actually you actually guessed right, which is good. So in order to know this, we're actually going to have to plug some numbers in. And so we wanted to use just a $500,000 portfolio to kind of show you the difference on how this worked. So if we have Portfolio B here, Portfolio A, if you have $500,000 at a 5.53% average rate of return, you would have earned $69,477. Whereas on Portfolio B, $500,000, same exact average performance would have ended up with $143,000 in growth. That's a difference of $73,000 more inside the portfolio, even though they had the same exact average performance. So as you can see, this is really important to know in your portfolio.
Oh yeah, I'm sure plenty of people come in to see you just like me and assume the wrong thing, but that's why you're there, to give them that kind of guidance to make sure they're headed in the right direction.
Oh, absolutely. Yeah.
And you actually have a special offer for those who want to come in?
Yeah, absolutely. So for anybody that wants to come in and sit with us, if you call us today, we'll actually give you a complimentary portfolio analysis. This is a great tool to actually find out if you have Portfolio A or Portfolio B. Believe it or not, the majority of people that walk into our office, 70% of people think that they actually have Portfolio B when in fact they have Portfolio A. So this is really important. As you can see, you can end up with a lot more money, and this analysis is your first step to getting that. So if you call today, we'll get you a complimentary portfolio analysis, and this is what my team and myself do day in and day out.
Reid, that was very informative, and of course you can see, I'm sure plenty of people come to you just like me, thinking a little differently, but you're going to set us straight. Okay, so to start your journey to a more secure financial future, call Lake Point Advisory Group. Here's the number to call. It's 214-771-3363, or simply head over to their website. It's lakepointadvisorygroup.com.